everybody's talking about how selective chemistries, after a hiatus of 3 years or a lull of 3 years or a consolidation period of 3 years, however you put it, might just start coming into play. Would that hinge on China giving the necessary stimulus? And is that the big talking point in a Trump 2.0 era? Let's talk about all of that with Nilesh Shah, founder and CEO of Envision Capital, with us in our studios. Nilesh, so good having you. Thanks for taking the time out.
Pleasure. Thank you so much, Neeraj, and wishing you a very happy new year, and hope 2025 turns out to be an extremely wonderful year for all of us.
Yeah. Cross fingers for all of that.
Yes.
Will it, though, Nilesh?
I believe so. I clearly believe, at least for the world, of course, looks very challenged. Multiple geopolitical, economic equations are at play, be it essentially what's the change in presidency in the United States, China trying to kind of make a comeback bid, and then several geopolitical flashes which continue to be on. But I think in that context, I still believe that India looks to be the place of not just potential, but I think it's a place where we will probably continue to do very well in 25 as well.
Okay. What could lead to this? I mean, simply because there will be a natural buoyancy out of the relative depths of growth that we kind of hit right in Q2, possibly even Q1, if you will. So H2 will be better than H1 for sure. But is that good enough, or would it need some more additional kickers, if you will, for investors to get excited about India once again? I mean, it almost seems that there is a lack of excitement, if you will, small sporadic moves here and there, but the market isn't going anywhere.
Yeah, that's clearly true for the headline space.
Right, okay.
If you look at the economy, grew at 6% in H1. Corporate earnings were again in single digit, and these are the top 50 or the top 100 companies which grew at high single digit. But if you step outside of that, are there a bunch of businesses which are growing at significantly higher pace? The answer is yes. So if you had basically outside the top 100 companies, if you had essentially a bunch of companies which you own, the earnings growth was clearly in the high teens to maybe even north of 20%. Similarly, and the other reason which gives me which makes me more optimistic are two things. One is we still have a lot of engines to fire, just generally as an economy. It's just that what worked for a $2 trillion economy may not work for a $4 trillion economy, and it may not work for an $8 trillion economy. So many more measures are required at the very macro level. And that, I think, we still have a lot of ammunition out there to fire. The question is, when does all of that start to fire? The second is, market has already taken a pause. If you look at the last 6 months, which is maybe July to December, the markets have been actually flattish. And I'm talking of, say, the Nifty 500 or the BSE 500. So to that extent, the market is already kind of now in that wait and watch mode. That are there some big bang economic measures coming in, or many of the other important tweaks which are required on the side of policymakers to ensure that from a 6% growth rate we go back to a 7 to 8% growth rate. I think so that basically a combination of that makes me a lot more kind of optimistic. The second is in terms of our interest rate outlook. Clearly over 2024, the calendar 2024, there were several measures to essentially curb lending, or I would say to restrict lending, and to ensure that the lending is more careful, more cautious, it goes more towards the secured side. And we've seen stress, be it unsecured, be it microfinance, we've seen that stress. Also, I think the interest rates kind of remained on the higher side.
Yeah.
I think in 2025, I believe that a lot of those restrictions which have been there will probably kind of ease out, and you will see back the banks coming back and starting to lend, which will drive growth, and two, on top of that, interest rates coming off if inflation does begin to moderate. So I see a lot of these things which I think should be positive.
So will this happen because the Reserve Bank will also be pro-growth, or is it because in your wisdom that the containment of undue stress has now been done well, and therefore there should be a natural opening up?
So if we look at the commentary of all the banks and the lenders, broadly what they're saying is that maybe the December quarter is when the stress will peak out. Let's assume that you extend that by another 1 quarter.
Right.
And the stress peaks out by, say, March. I clearly believe that that's about it. I don't see essentially this challenge being spilled over because the growth rates itself have moderated. There hasn't been significantly higher amount of lending which has done between April to now, or maybe even up to March. So I clearly believe that there's really not much now. I think we would have seen the peak of the stress.
Got it. Okay.
And I think we will get back into a business as usual mode start April. And I'm talking of the banking system, the credit economy, those kind of things. And that itself will essentially act as a stimulant for growth.
Okay. Yeah, BAU is much more desirable. The slang for business as usual, viewers, in case you were wondering. Okay. And Nilesh, I mean, just a leaf of what's happened in the last 24 hours and the numbers from Avenue Supermarts, from V2 Retail, from some of the auto companies as well, passenger vehicles in particular. Maybe the street was bracing itself for disappointments and they have not been disappointing. But I mean, the stocks have been on fire. Now, my question to you is, were you also in the camp that believed that urban consumption is also suffering? And are these data points a bit of a respite that maybe things could be slightly better than what the fear on the street was?
So, Neeraj, I think urban consumption has not been as bad as what it is made out to be.
Okay, you think so?
I believe so. And why I say this is because when we kind of, especially we as financial market investors, we tend to think about HUL and Nestle and that pack. But the reality is that there are two shifts which are happening. One is a shift to D2C brands, which means that there are several new brands, new products, which essentially are basically getting funded by private equity, venture capitalists, and they are driving growth. And so clearly there's a shift in the consumption happening.
Yeah, you've spoken about this in the past, yes.
Second is clearly from the basics to the premium side, or the whole move towards premiumization. That's the second. And the shift in terms of trade from products to platforms, which means that no longer can the veterans just sit on their laurels and saying we have this great distribution network of millions of Kirana stores across the country. I think quick commerce has come in and pretty much disrupted the distribution landscape. So modern retail has to some extent taken away some share from the conventional Kirana stores, and now quick commerce is taking away share from the modern retail. So if you look at the numbers of the quick commerce guys, they are growing at 30, 40, 50%. If you look at the numbers of some of the names you mentioned, be it DMart or V2 Retail, it's all in high teens, right? So where's the slowdown? And then look at the numbers of the automobile guys, the car guys. They're back with a bang.
Yeah.
So I'm just saying is if you look at all of this, then there is really no slowdown. So it's basically a situation of two halves.
But interesting. So I was talking to Sajid Chinoy on a podcast, and he was saying that the savings rate of the average Indian household has come off from the 3.5%, 3.7% during COVID to flattish levels, right? So, Nilesh, is that a natural progression because during COVID savings were high and then they would deplete and then they would again decline? And does that worry you at all from a consumption perspective?
No, it doesn't, because clearly I think today investors or savers are wanting to consume more and more, and that's the trend you will see with an aspirational India. As we all get more and more aspirational, we want to essentially consume. We want to consume the more big ticket stuff, the more premium stuff. Okay, I mean, look at the world's most successful economy, the United States. What are their savings rate? Has that stopped them from being essentially a successful economy? No. Has that in any way created roadblocks to the shift from a developing to a developed economy? The answer is no. It's more also a question of credit being available and available at a reasonable price. So gone are the days when interest rates used to be in those very high double digits. Today credit is available at an affordable rate. So it's quite natural that you will see some shift or some depletion in the savings rate, but that doesn't mean there's gloom and doom.
Got it. Nilesh, the last time that we spoke, it seemed to me, I don't have it verbatim with me, but one of the takeaways was that independent of what the Nifty does, specific sectors, etc. do, you will find the bazookas, which could actually have some meteorical growth in the next 4, 5, 6 years, etc. We didn't have time then to talk about what themes could these belong to. Hopefully, we have about 3-4 minutes even right now. I'm just trying to understand. Do you still stand by that view that the next 3, 4, 5 years, investors would have the chance, and you are finding those opportunities which could actually give between 30 to 50% CAGR returns for the next 4-5 years?
It's quite possible, and I'm not too sure whether that would imply a 30 to 50% CAGR returns. The businesses could grow at 30 to 50%, but in some cases, a lot of that has kind of the valuations have priced in. So if not 30 to 50%, but even if it is half of that, that would translate into 15 to 25%, okay, which itself is a very, very decent set of returns for a long period of time.
Yeah.
It may not sound very exciting from a 6-month, 12-month perspective, but clearly from a 5-year perspective, if there is a range of businesses which give you 15 to 25% returns as investors, I think that's a fantastic place to be. So I clearly believe that yes, there are going to be pockets which will grow at north of 30%, which will translate into kind of, high double-digit, high teens, or maybe returns in the 20s.
Okay, a lot of people are invested, let's say, for example, in EMS, right? And the opinion gets divided. So, for example, today people would have been thinking that, okay, there is one house broker which is saying that they are constructive, but their target price on the top EMS player, Dixon, is 50% lower than the current market price. And there's another broker who's hiked the target price to nearly 30% higher than the current price as well, right? A 10,000 rupee gap between two targets can very well happen. We've seen this in the past.
Yeah.
But the more important point is, from your perspective, is the growth into that EMS space, for example, high growth space, so I'm using that as an example, justifying the very egregious valuations that they're sitting on right now, or do you think something will give?
So Neeraj, probably on the EMS side, a lot of it seems to have got factored in. Okay. On the EMS side, and why I say this is because the valuations are kind of super high. Revenue growth will be there, but the margins are not good enough for you to be able to generate cash flows to be able to reinvest back into the business. The business to sustain that 30 to 50% growth rate will require a lot more capital, require a lot more working capital. And the margins are not so high that you essentially will generate internal cash flows to be able to fund that growth. So therefore, you will have to, I think from here on, leverage because the size has grown big, or you will have to raise equity capital, which will essentially be ROE dilutive. Okay, and that essentially is not a great place to be in. But if I were to kind of remove the E and just look at manufacturing services, it doesn't matter whether I'm providing manufacturing services to make electronic goods, or my manufacturing services are coming into areas like defense, like aerospace, like semiconductors, where I still think we are in the early stage of the cycle. The EMS cycle is pretty much now already about 3 to 4 years kind of into it. It's out of the infancy stage. It's become a relatively advanced or a mature stage. But when you look at aerospace, defense, semiconductors, and some of the other things, that is where the entry barriers are even higher, margins are even better, and the runway of growth has just started. And we probably have another 10, 20 years to go before essentially this, even we can say that this has got mature, it's got advanced. So that's really where I would probably think within the area of manufacturing is where one should essentially be focused on, number one. Number two, I also believe that's a strategic priority for the nation, for the economy, because all of that helps you to indigenize.
Right.
So when we talk of indigenization or Atmanirbhar, it's essentially going to be these pockets which will help us to get towards indigenization. Even areas like, say, renewable energy, when you're making things for solar power, when you're making things for wind power, when you're making things for hydrogen, I actually look at it as indigenization, because what is that going to do? Import substitution.
Yes.
It'll reduce your import of crude oil, reduce your import of coal, and make you shift towards solar, wind, etc., which are all indigenously produced sources of energy.
Right.
So I look at indigenization in a very broader context, and within that, manufacturing is going to play a very, very important role.
Okay, well, viewers, while he hasn't said a yes, but what we will do is, we'll get in Nilesh Shah, hopefully at some point of time in the next month and a half, 2 months, on Talking Point Unfiltered, our podcast, wherein we try and talk about the non-EMS space in detail and try and pick his brains on that. But Nilesh, lovely talking to you today at the start of the year. Thank you so much from all of us.
Thank you. Thank you so much, Neeraj.